what do you do after we've had this tremendous volatility over the last week and still have the trade and monetary policy overhangs?
So just like any roller coaster, we think this one's going to end up basically where it started. So our target for the end of the year for the S&P is basically about where it is now, in the 2,800, 2,900 range. I think you're going to see more trade-related volatility. I think investors should assume that obviously we're going to have the September 1st tariffs go into effect. Until further notice, assume that the December 15th tariffs will also go into effect, and we could potentially escalate from there. So I wouldn't be, discounting the idea that we're not going to see escalation just because we're approaching next year's election.
But can the Fed make it all better?
We don't think so. It's not clear the Fed could have to surprise people with a mid sort of meeting rate cut or 50 or 75 basis point. I just don't think we're going to hear that from Jay Powell this week. I don't think we're going to get that from the Fed. If they just do their orderly 25 basis point per meeting cut, that's basically, just what's expected, and therefore not going to be a huge boost, I think, to the equity markets, and not going to be a huge boost to the economy either, where the consumer is not really overly leveraged and doesn't really need these rate cuts at the moment.
Kirk, what are you telling your clients?
Well, I think you want to look for non-correlated assets. What's interesting here is I think if you try to trade this market, it's an opportunity to lose money. I think you want to look through the next 2 months. I think you're going to see a lot more volatility until the trade dispute settles down. And I think what you want to do is you want to say, I want to own stocks towards the end of the year, but I wouldn't be trading this market here.
Kirk, as somebody who has experience in fixed income, I know obviously you oversee all asset classes now. Our last guest, Kyle Bass, was talking about the fact that he thinks we could see 0% interest rates as money continues to flow over here to try and get some sort of a return. Where are you on that argument?
Well, I think the bond market's gotten a bit ahead of itself. The Fed funds futures market looks like 100 basis points lower in the 1% range, and the market wants the 2-year at 50 basis points. I don't think that's going to happen. To your earlier guest point, I think 25 basis points is probably expectation, maybe another cut by the end of the year, but I think the bond market's gotten ahead of itself.
What would happen to stocks, Brian, if in that kind of environment, if we saw rates go lower and lower and lower all the way to zero?
I think it depends why rates are going lower. If they're going lower because we're continuing to see bad economic data, the stock market's going to follow it down. If we see central banks coming in with a bazooka, and that's been kind of the rumored ECB measure that we're going to see in September, we could see rates go temporarily lower because there's a sense that they can actually put their boot on the end of the yield curve in Europe, and that could cause U.S. rates to fall down with them, but that wouldn't necessarily be a bad thing for the equity markets here in the U.S.
So, Kirk, if bonds are ahead of themselves, does that mean equities look like a better bet right now?
Well, the yield on equities is better than the 10-year Treasury and the S&P 500. So I think that equities, in terms of relative value, look pretty good. But again, I wouldn't look for, trading this. But I think towards the end of the year, I think it's possible once we get through all this, which we will, I think the administration will sign some kind of deal. I think it's possible that equities could start to move up towards the end of the year.
And yet, growth stocks still seem to be in favor over the higher dividend yielding sort of value stocks, Brian. So how do you play that strategy given we are seeing lower and lower yields?
Yeah, we're trying to look for the overlap there. We're trying to stay defensive. But obviously, anything with the yield is going to get a pretty strong bid at the moment. We're also looking for undervalued growth. It's hard to find that these days with growth so low. You tend to see growth stocks get bid up. Tech's having a fantastic year. One area that we like that hasn't done as well is healthcare. That's gotten beaten up for the political announcements from some of the candidates. There's been a sense that there's risk around healthcare. We don't think that that's as huge a risk heading into next year. And that's one area where it's defensive and also growthy, and that could be an outperformer in the second half of the year.